from the school system to support that when money starts to be withdrawn, which is still quite a ways down the road. So I've talked a little bit about many of the drivers of capital market returns here. Does anyone have any questions on the economic and market before we talk about the fund specifically? All right, either you forgot to take your mute button off or there are no questions. So we'll just continue to move forward here. And I know there's a fair amount of business to attend to in this meeting. So I'm not skipping pages because we don't have comments about those pages. I'm skipping pages because I want to hit the points that I think are most important. Certainly, if you've read through the report and have any questions about any part of the report, I am happy to discuss those with you. At the end of the last quarter, the value of the trust was down to $139 million. That was down from the previous quarter's close at about 146. The return was negative 5.25%, which slightly beat the policy benchmark. And that was due in large part to the fact that we saw the international manager returned to a period of outperformance relative to its benchmark. You'll recall that we've talked about American Funds Euro-Pacific growth quite a bit during the first couple quarters, because many of the things that they had been doing and doing well that had led to outperformance in that portfolio leading up to the beginning of 2022 were the very reasons that that portfolio underperformed during the first 6 months. We've consistently spoken with them and held the belief that this is a manager with a very strong long-term track record, and we expected that they would turn that around, and we've seen that in the third quarter where they outperformed their benchmark by 58 basis points during the quarter. They're still underperforming for the year to date and for the last 12 months, and that's mostly attributed to that 6-month period from the beginning of the year to the middle of the year, when it underperformed relative to the benchmark and to peers. But again, if we look at the longer term performance, the 3, 5, 10-year performance for American Funds Euro-Pacific growth, it's still very good. It's still in the top half of peers, and it generally beats its benchmark. Dodge & Cox was also a positive contributor. You'll recall that we have a split strategy of active managers in the fixed income, with Dodge & Cox being the larger manager in that space, due in large part to the fact that they have a more conservative position or a more conservative strategy, and they outperformed the benchmark by 77 basis points for the quarter. And they've been a continued positive story as fixed income markets have struggled. The active management of Dodge & Cox has been either in line with the benchmark or has beaten the benchmark. The same cannot be said for the Western Asset Core Plus, which is the smaller allocation. They tend to extend out into some below investment grade investments. They also make larger bets relative to duration. And as a result, they have been hurt a lot more by the move to increase interest rates, by the aggressive nature of the Fed increases. It's really hurt the Western Asset Core Plus fund, where its performance now is fairly low relative to peers and relative to the benchmark for most of the near-term periods. And that has bled over into their 1, 3, and 5-year returns, pulling them into the bottom half relative to peers and into the bottom quartile in many cases. It should be noted that the fund, the performance of the fund over the last 10 years is still in the top decile relative to peers, meaning it's outperformed 90% of its peers over the last decade. But given the performance that we've seen in the near term, we made the decision at Bolton to put Western Asset Core Plus on the watch list. And I'll talk a little bit more about that. Leslie asked us to put some of that in writing, and we have a memo that we put together and that was distributed to the committee. But I'm happy to talk in more detail about Western Asset Core Plus and what it means for that to be on a watch list here at Bolton. So As far as the other elements that I would look at, the asset allocation shows that the fund was overweight to fixed income by about 2.75% or 275 basis points as of September 30th. That number's come down a little bit as equities have outperformed in October. And that allocation is still well within the bounds of the investment policy statement. So we're not recommending any rebalancing at this time. And I'd also point out that the OPEB's investments have outperformed the policy benchmark over all of the significant periods, the 1, 3, 5, and 10-year period. But that asset allocation strategy, we constantly talk about this. We expect that will outperform its benchmark and will outperform peers when equity markets are more positive. And that's because we've taken a stance that adding that volatility, having a higher allocation to equity than maybe some of the other funds that you sit on or that you have exposure to, is going to give us a better opportunity for return over the long run. And with a portfolio that's not withdrawing money, we have the ability to withstand periods like what we're seeing right now. So we don't want to get too caught up in short-term performance in a portfolio that's really geared to not take any money out for 10 years or longer. To equate that to maybe your individual accounts, if you're somebody who still has 20 or 30 years until retirement, being concerned about the volatility in the market right now when you're not going to withdraw that money for 20 or 30 years can typically lead to selling out of markets at the wrong time or waiting too long to buy in and missing out on the opportunities that volatile markets present. And this portfolio is very similar to that young person who still has quite some time to go until retirement in terms of the allocation and the viewpoint that we would suggest that you have as you evaluate the performance. So I'll move forward to the performance because I've talked a little bit about outperformance and underperformance here, and just want to reiterate some of those points in looking at the specific performance of the funds themselves. Again, the passive investments in equities continue to do exactly what we expect them to do. Their performance is within a few basis points of the benchmarks that they are trying to match. And so there's no concerns there. The expenses are exceptionally low in those funds, and we continue to see performance as would be expected. As I mentioned, Euro-Pacific growth outperformed for the quarter. Year to date, it's still underperforming the benchmark by 5.5%, and the 1 and 2 year, it's underperforming on an annualized basis. But again, if we look at those 3, 5, and 10-year numbers, it's outperforming the index that it's benchmarked against, and it's also outperforming peers in the top quartile for 5 years and in the top decile for 10 years. Those numbers in parentheses next to the performance indicate where they rank relative to peers. I mentioned fixed income, and as we go to the bottom of the page, again, you can see Dodge & Cox has beaten the index and ranks very well against peers across all of the time periods. And part of the reason that we pair Dodge & Cox and Western Asset together is because they're very complementary of one another. But in a market environment like we've seen over the last 9 months in fixed income, Dodge & Cox has done very well, whereas Western Asset has not performed as well. And you can see here why we've put this fund on the watch list. It underperformed for the quarter. For the year to date, it's underperformed by 6.7%. And for the 1, 2, 3, and 5 year periods, that recent underperformance has dragged down those numbers and sees it rank very low relative to its peers. But this is something that we see in this type of performance where a period of underperformance can adversely impact those longer term numbers, particularly when it's as significant as it is right now. I would point to the calendar year performance, which I'm showing here, which shows that Western Asset beat the benchmark in 2020. It beat the benchmark rather handily in 2019. It also beat the benchmark very handily in 2017. And in 2019 and 2017, this is a fund that ranked in the top 3% of funds in its category. So what we've done, and I'll switch over to the memo now so that we can talk a little bit in more detail about the watch list and what Western Asset means. When we see a fund like Western Asset and we see the performance underperform so dramatically, our first question is, has something changed at Western Asset? Is there a new manager? Has the strategy changed dramatically? Are they doing something different than what we hired them to do when we brought them on as a manager for the portfolio? And so that in and of itself, those questions get answered on calls that we have directly with the Western Asset. And those are calls we've been having very frequently throughout the year so that we understand what's going on at Western Asset. And the answer there is nothing's changed. The manager is the same. The strategy is very similar to what they've been running for the last decade. What has changed is the market environment. And so then the question becomes, do we foresee a circumstance where we might make a change to this manager? And so back in March, when we first saw the underperformance, we said, well, this is kind of what you'd expect in this environment from a manager with a portfolio that looks like this. We expect things are going to rebound. We expect that they may adjust to what's happening in the marketplace. We may see the marketplace change and move in their favor again. In June, we had more doubts about that. Now in September, we can see a clear path where we might make a change to Western Asset. And that's really why we put them on a watch list. We don't want to put a fund manager on a watch list if we don't see a circumstance in the future, in the next 12 months, 18 months, where we might make a change. And in March, we didn't see that. Their long-term performance was good. They're still doing everything that we expect. In September, their 10-year performance still looks good, but the nearer term doesn't. And their strategy is so significantly out of favor right now that there are other managers that do similar things to what they do that we could see a potential replacement in the future. But we don't want to go that route until we have entered an environment where we can see if they rebound, if their strategy that did so well in those calendar years that we just showed you doesn't rebound as we get through a full market cycle in fixed income. Now, if that market cycle appears to continue to extend out, we could certainly see where we might make a change there. It's important to remember that watch list is driven by your investment policy statement. And that's why in the memo, I included the section from the investment policy statement that talks about the watch list. There's a whole variety of factors that may lead to us putting somebody on the watch list. Failure to meet performance standards is at the top of the list, but there's certainly other reasons, and simply not meeting performance standards for one period of time is not enough to go on the watch list. This has been a more significant period of time. Thus, we've put them on the watch list. It indicates a heightened level of scrutiny by us as your investment consultant. We continue to talk to them. We continue to do analysis of their performance. We continue to monitor it to see if there's an opportunity for it to improve. This fund is probably one of just a handful that's under a microscope at Bolton right now. So I can talk a little bit more about this. Watch list removal is done on a case-by-case basis, just as adding it is done on a case-by-case basis. And that's because there's so many nuanced reasons why we may put a fund on the watch list. What we really want to see is, does their strategy see outperformance in periods, even short-term periods, where rates stabilize or where rates may go down a little bit, or we see yields go down a little bit. If we see that, that validates their strategy that has outperformed over such a long period of time. And should we see the Fed start to cut rates in order to stimulate the economy once inflation's brought under control, it may be that Western Asset for several years is in that top quartile, top decile, as the market moves in the exact opposite direction of what it's done in the last 9 months. And we wouldn't want to miss that because we decided to remove a manager during the worst period of their performance that we've seen in the last decade. So we tend to move to the watch list slowly. We tend to remove managers slowly, but we do that because we don't want to miss those opportunities as they come back. We don't want to be chasing performance by only putting managers in that have performed well historically, but may not perform as well prospectively going forward. So I've done a lot of talking around this. I'd like to answer any questions that you may have, or have further discussion around this. But that's the bulk of what I had to discuss today.
Okay. Any questions for Bolton on the performance review or on the issue of the watch list for Western Asset?
Hey, Alton, this is Brian. Probably more comments than questions, but as I think of WAMCO, I think of them as kind of a beta play to the equity markets because of the high yield and kind of core plus not concentration, but positioning. So this is probably the worst type of market for their fund to perform in. And to your point about where if rates were to at least stabilize or roll over and the equity markets rallied, I would think they would also rally pretty heavily with that. So I do think it's probably prudent to just kind of continue to watch and see how they do. And I would hate to sell it or exit it and then miss that. I guess my question is, if, and I'm not necessarily advocating this, but if there was a quote runner-up or if there was an alternative investment, would you have someone you would recommend as we think again longer term? And I'm not again saying we should do this. And would you add them to the watch list? And what I mean by that is there another alternative fund that we could watch in parallel and see how the two perform if there ever became a time where we would want to exit WAMCO?
Yeah, so that's a good question, because that gets to the process for a replacement should we make that recommendation. And we are constantly looking at multiple managers in all of the major asset classes in which we make recommendations. So certainly there are other core plus fixed income managers that we are tracking on a quarterly basis and that we would be able to recommend as a replacement to Western Asset if we get to that point. And one of the, you do get at one of the decisions that we're constantly looking at, which is they're not the only folks in the core plus space. Are there other managers that are doing better? And what are the reasons why those other managers are doing better? Is it because they're doing a better job of managing in the space, or are there some fundamental differences in their strategy that lead to those managers doing better in this particular environment, but they might not do as well when the fixed income markets rally? The question is always, what manager do we want to be in going forward? And lacking a crystal ball, there's not a clear answer to that. The data we have is always backwards looking. And so you're trying to extrapolate from that backwards looking data to determine where you want to be going forward. And so that's a bit long-winded, but yes, we are constantly looking at other managers. We are constantly making an evaluation, looking forward. Is there one we'd prefer that we would recommend to our clients over the one that they're currently in right now? And that evaluation is a long-term outlook, not a short-term outlook. And I make that distinction because you could go back to February, March, April. It was pretty clear that the Fed was going to raise rates for a while. It's pretty clear that at least for the next 6 months or 9 months that those fixed income managers with exposure to duration were going to underperform. But we're not trying to trade the portfolio every 6 months or every 9 months. We're not trying to be tactical like that to try and say, okay, for the next 8 months, we think that Western Asset's going to underperform. So let's get out of Western Asset for 8 months and then try to figure out when to get back in. Our goal is to construct a portfolio based on long-term performance throughout entire market cycles. And sometimes that means that a manager is going to underperform for some period of that time.
Got it. And then a follow-up question, and to your point, I think we play the quote long game, so I get that. And I know we don't, as you said, we're not trading in and out, we're not being more tactical. But if you felt, or if the view was higher inflation for longer, and if we think that 2% is going to be kind of elusive longer term, would you recommend anything at the margin of how we allocate the portfolio in that world?
That's a good question, and that would be a question of, first of all, do we believe that inflation is going to be more persistent than is the general expectation right now? And if you believe that inflation was going to be more persistent for longer, then some investment around some of the intermediate term bonds that are looking very attractive right now. You know, you're getting 4 and 5% on some 3-year fixed income securities. Something like that might make sense. But that's really what we're hiring these managers to do. That's what Dodge and Cox's job is to manage the fixed income portfolio based on their outlook for the next 6 months, 12 months, the next year. The reason that we're not tactical is because we are effectively hiring managers in the places where we think active management makes sense, and we're telling them to go be tactical. We're telling them to have their outlook and make those decisions. And so that's where, we don't necessarily need to decide as a committee that we think inflation is going to be more persistent or less persistent, because we're giving money to managers whose job it is to do those things.
Alton, so if I'm understanding correctly, and to use Brian's term, if we're playing the long game, there's your philosophy or your vision here is that this committee can't do or shouldn't do anything at all to try to mitigate the losses we're having over the last year, and probably looking forward to more losses over the foreseeable future, that we're just basically in a position where we need to ride it out.
What we're suggesting by taking the long view is that saying, trying to mitigate losses that we see in the short term has been proven, being tactical in that manner has been proven to actually lead to lower returns over the long run. Because in order to mitigate losses, you have to move out of assets as they're falling, but you also have to buy back into those assets before they come back. and before they rise. And historically, trying to be tactical in that nature, you generally tend to sell too late, and you tend to buy too late. In other words, you sell after it's already down significantly, and then you don't gain the confidence to buy back in until after that investment has risen above the point at which you sold in the first place. In which case, staying in the investment through the whole cycle gives you a better outcome than trying to time those sales on the way down and those purchases on the way up. Really, one of the ways that we try to mitigate some of those losses, though, is through asset allocation, by having assets that are not necessarily correlated with each other, getting exposure to asset classes that don't move in the markets for all the same reasons. We talked a little bit about this when we presented the asset allocation presentation before, and we'll continue to bring ideas for further diversification to the committee going forward. But yes, to some extent, playing the long game does mean waiting it out through these downturns and reminding ourselves that we've seen the value go down, but we haven't sold anything. And those losses that we see in value are not really cemented in until we sell out of the market. And so therefore, we have all the money invested and all the opportunity to recover as the markets switch and go in the other direction, which they'll do. It's hard to see right now, but they will move back in the other direction. And frequently they do so for much longer and to much greater heights than they go down and the depths that we get to during these downturns.
Okay. First, I want to apologize for being bumped off the internet here at the school system. I had to get back in. So I appreciate you guys with your great questions and Bolton and your explanations. At this point, Bolton, if you see and are tracking that Western Asset is continuing to underperform, would this be something in February when you come back, you may start to present other options for us at that time, or would that be too soon?
It could be something we do in February. Again, it's really going to depend on what we see from Western Asset. What we'd really like to see there is, as inflation abates, and we're hoping that it will continue to do so, the signs seem to be pointing in that direction, at least with the October number being lower than September, which was lower than August, which was lower than June. And as the Fed starts to comment maybe about slowing the interest rate increases, we'd like to see Western Asset bounce back fairly quickly. If we see that, we're going to have a lot more confidence that their strategy is going to benefit from any sort of rebound in the fixed income market. If we don't see that, we could certainly come back in February with a recommendation to make a change. But if things kind of stay status quo, maybe their performance goes from being, underperforming by 160 basis points to underperforming by 20 basis points. We may be in a holding pattern for a little bit. And to be fair, other core plus funds are underperforming the U.S. aggregate index, and they're underperforming somewhat significantly. So as a class, those who are exposed to duration, this is a bad environment for them, and it's historically bad. It's the worst environment we've seen in 30 or 40 years for them. So I can't give you a solid answer there, but I can see a situation where things deteriorate and we'd come with a recommended change. I can see where things move in the other direction and we'd tell you, hey, they're still on the watch list, but things look better. But I think the most likely scenario is we come back in February and say, we're still watching these guys.
Okay. Do you have a current asset listing and where we are in the last week or so?
I don't have one right at my fingertips, but I can probably get that and send it over to you, and you can distribute it to the committee.
Okay, will do.
I can tell you the number's higher. I've looked at it for a number of other clients, and for most of them, they have recovered all of what they lost or close to what they lost during the third quarter. They're back to June 30th values.
Okay, well, that would be good news.
Yes. So I'll look that up and I'll send that over to Lynn, and she can distribute it to the committee.
Exactly. Okay. Are there any other questions for Alton before we prepare to go in closed session? Okay, before we go into closed session, I read the closed session announcement while we're recording. I wanted to take the opportunity to thank Mr. Young. Brad has been on the OPEB committee here since we took it over in 2008. But he has also been a proponent for OPEB way before 2018, way before that. When Brad came on the board, he definitely raised the awareness to the other board members about this liability for OPEB and the importance to start to pre-fund some of this liability. It was something before they would send literally pittance over there once in a blue moon. And there was really no strategy or major contributions. And so we were fortunate for 2 years, FY 2012 and FY 2013, Mr. Young's boards contributed over $14 million in those 2 years. And that was significant. That's a significant deposit that helped grow this fund. And even after that, even after they had to lower that because of the recession and the demands on needing for salaries, because we'd gone many years without salary increases. And so it became a decision between, do you increase your employees and their salaries, or do you continue to contribute this money into OPEB? Unfortunately, they made a very tough decision to decrease the OPEB contribution. But that $28 million infusion into the OPEB trust fund back in those years has allowed it to have the opportunity to grow over some, very strong market years. And so I just wanted to thank Brad. I'm thankful for his attention to this, his constantly banging on the board and telling them about this and how important it is. I'm hoping he'll do the same when he's over on the county council and continues to stress the importance of funding this liability, because it benefits all of our employees and all of our current retirees and all of our employees who 10, 15, 20 years down the road, they do not want to see a major difference in their insurance premiums, nor will they want to see a change in the product that is being offered. So I think the more we can stabilize it with these funds in our trust, the better off we're all going to be. So Brad, thank you very, very much.
Thank you, Leslie. And again, it's been a whirlwind 12 years on the board. It's gone by very, very fast, but we're very lucky at FCPS to have you and your staff and the professionalism of presenting numbers and being able to look at things and understand them. And to, the committee, the members that are here and participate, whether you're FCPS staff or our community members, it is so important because this is a huge liability that our school system and our county face. And we want to make sure, as you said, that I've always said I would not want to be on a board 20 or 30 years from now saying, sorry, retirees, we can't honor that commitment we made because we didn't save for it. And so we need to continue to save. We need to continue to perform on the investments and honor the commitment that we're making to our employees as they work, and more importantly, when they retire. So it's been an honor. And again, we'll be on the other side of the street watching.
Well, we're glad you're over there. Thank you.
Thank you.
Okay, Alton, I will ask you to leave the meeting. We have to read a motion to move into our closed session. So in accordance with Maryland's Open Meetings Act, General Provisions Article 3-305B14, the other Post-Employment Benefits Committee will meet in closed session at 9 a.m. or actually we're at 9:16 a.m. to discuss a matter directly related to a negotiating strategy or the contents of a bid or proposal being public discussed or disclosure would adversely impact the ability of the public body to participate in a competitive bidding or proposal process. So do I have a motion to move into closed session?
I motion to move into closed session.
Okay, Derek raised his hand. Tony, I also saw your hand. I'll take that as a second. Okay, all those in favor of moving into closed session?
Aye.
Okay, we'll do so.